controls relative to the core PCE inflation rate. This is a longer-term chart, goes back more than 20 years, and you see that we've gotten this massively steep tightening cycle. It's brought in the upper bound of Fed funds right now to 4.75%, and that is slightly above the last reported core PCE level. Now, tomorrow, you're expected, based on economists' forecast, to see a little more improvement in the inflation rate. Core PCE projected at 4.3, so just a real incremental decline. And I think there's a lot of discussion as to whether, in fact, there might be an upside surprise because of some stickiness and some methodology issues. But what you'll see is in past cycles, the Fed did get the Fed funds well above the inflation rate before the overall cycle ended. This was in 2 years or so before you got to a recession. That's been the case in the past as well. Look at the long period of time where Fed funds remained below a low inflation level back in the 2010s. It shows you what a radically different world this is now. If inflation starts to really decline toward the 2% target, you're going to find the Fed funds as being very restrictive, and it's slowing down the economy as expected and creating a higher real interest rate yield that people will necessarily believe is both going to do the job on inflation and maybe bring inflation risk, but I mean,